Well, welcome back, everybody. Thanks for joining us today in this very, very hard lockdown period. You can't even get a haircut or play tennis, not even singles. But we can at least still speak and see Alex Jamieson from AJFinancialPlanning, who joins us, albeit on conference call. He is the director totally. There's no one else helping. And it's great to see you, Alex. Welcome aboard.
Thanks, Greg. Great to be here. I've got the earpieces in so I can hear you loud and clear. And yeah, looking forward to catching up. Maybe our next update with face-to-face contact. That'd be great.
Well, let's please do that. This has gone on too long. Anyway, look, today, do you mind if we talk about monetary policy? I know we've spoken a bit about it in the past, but can we take a closer look? I mean, how does monetary policy affect investing?
Yeah, I think for me, it's sort of, if I took you into a room and I said, Greg, I want to set you up to win. So if you do X, Y, Z, you've got a high probability of success, and the way that the house rules are set up, you'll likely be successful. If you do these set of rules, A, B, C, your probability of success is going to be really average, and so you're not going to get a great outcome. And so monetary policy is this sort of mystical kind of beast that people hear about. Oh, interest rates are up and down and all that type of thing, but no one's really sort of drawn that curtain back behind and said, well, how do I take advantage of this? How do I set myself up to win? And so monetary policy is driven by the central banks, so the US Fed, the RBA, and a couple of the key policies that they can do is they can increase, decrease interest rates, or they could flood the market with money, which is called quantitative easing. The thing, if we look at this slide, is usually when they use what we call unconventional monetary policy techniques or tools, essentially it really favours the wealthy. They have assets, and those assets typically increase during these periods of time. And the poor, unfortunately, they hold mostly cash-based assets, if any at all. And unfortunately, they're, from a social perspective, really disadvantaged from these types of tools.
Okay, when you're speaking about unconventional policies, in essence, you're meaning increasing the money supply through quantitative easing.
Yeah, definitely. There's a couple of things they can do. They can drop interest rates to really ultra low levels, and that can make it really not favourable for people, or punish people that are holding fixed interest to go and do something with it, force them. It's kind of like the gun to the head. The other thing they could do is, quantitative easing, which is sloshing a whole lot of liquidity, whole lot of money into the system that's easy to access by people that can access it, and that hopefully stimulates and drives the economy as they put that to productive use. The thing with it though, sort of like a prescription. So you go in and see the doctor and they say, oh, I can see these, you're suffering from X, Y, Z. We're going to give you some medicine. These are the side effects, but don't be too concerned. We're going to get you better. The monetary policy is the same. Is, I can do these tools, increase interest rates, drop them. I can slosh the money into the economy. The side effects are it's going to inflate assets, but that's okay because most people have them and the economy will get going, and anyone that doesn't have them, they'll probably pick up a job and make a bit more money, and that's how they kind of, I guess, get comfortable with it. But certainly we sort of see, as this slide sort of said, there's been a heap of academic studies around it where it's basically sort of, as soon as you hear that word unconventional monetary sort of policy, straight away that person in the room that's holding growth-based assets, they're set up to win, and they're actually set up to win each downturn. So we sort of saw these tools come into play in the GFC. They've redone them with COVID. Looks like they're going to be doing these every 8 to 12 years, and anyone that's holding assets that grow, like shares and property, are really going to benefit. And they're set up to play the game with the rules that have been outlined and benefit from those rules.
So can it be said that the general framework is set up to benefit growth-based assets such as shares and property?
Absolutely. If we take this slide, this is from the annual report from the Reserve Bank of Australia. It's basically looking at their objectives. Their objectives haven't changed for a couple of decades. They've introduced a small extra one since the original set of objectives, but in essence, it's sort of keeping a stable currency, full employment, trying to keep economic prosperity, and they're trying to, this asterisk one in the talking marks, it's sort of saying keeping the economic inflation rate at around 2 to 3%. It's been a bit below that, but straight away, if I sort of said to you, Greg, just as a question, I posed it, I say, look, Greg, I've got $1 million on the table right now. Do you want it now or do you want it in 10 years? What would you say?
Well, what do you think I'd say? Of course, I'd have it now. Thank you.
Show me the money. Show me the money. And the main reason you're going to say that is because, it's a dollar today is not worth a dollar tomorrow. The $1 million today is going to be worth a hell of a lot more than what it is in 10 years' time. So again, walking into the room, knowing what the state of play is, what is the rules, and basically the RBA's rules is basically saying, if you hold growth-based assets, you're set up to win if they're the right ones. Whereas if you're going to hold cash and just fixed interest, they're not going to be worth nearly as much as time goes on. And we're actually setting a whole strategy around that to disadvantage those sort of people. They're not communicating it in those terms, but someone that may not have sort of stepped back and had a look at their annual report, say, well, what are they really doing? That's what they're trying to do, is say, hey, look, we're actually trying to devalue your value and push value of the cash and push up the value of your growth-based assets. And so, certainly from that standpoint, growth-based assets over the long to medium term, the policies are set up to try and benefit those.
Well, that being said, is there still always a need to have some cash or fixed interest in a policy?
Absolutely, yeah. Any investment strategy, there is still a 100% justification for having it. So, someone in retirement, they're needing to hold that as a precautionary risk management strategy, multiple years of pension payment. They're a nervous investor, don't want the volatility. It's trying to get something that's going to cater for them. So I don't want to be sort of out there saying, oh, you only need to hold growth-based assets. That's not the key message. It's saying, look, understand the rules of play. Typically as well, somebody that's new to investing, not wanting to take on a lot of risks, it may be suitable for them to start out slowly. So we certainly, as a firm perspective, still incorporate fixed interest. But if you're looking at a pure investment strategy that's around wealth creation and you're trying to do it solely on fixed interest or cash, you're not set up to benefit longer term. The way the system has been built together is not really, unless there's sort of even in a hyperinflation, you're still not going to be set up to win because your interest rates won't be high enough to offset the acceleration. So you're really in a difficult position to benefit longer term if you're taking that type of approach.
Okay, from what you've said today, do you think there are some long-term issues for the general population around social inequality and monetary policy?
Yeah, absolutely. Our firm's sort of been looking at a number of academic studies in this area of this social inequality question. And we wrote a piece before we started the quantitative easing and saying, look, if Australia goes to quantitative easing, what we've seen historically and in the academic studies is that it really tears that fabric of society between the haves and the haves not. The inflating of the assets, the wealthier become more so, and the poorer, unfortunately, are getting further and further behind. The OECD put together, I guess, they call it a Gini coefficient. We have a look at this graph. This is an example of a more recent one. And they're looking at the population base and sort of, it's kind of like making sure everyone, a social policy, so it's making sure everyone's sort of within cooee of each other in relative terms. And the wider that gap gets, the more you tend to find social unrest or issues, and the economies do start to sort of struggle a little bit with those sort of big social issues. And so really what we sort of can see here is some of these countries that have done quantitative easing through the GFC, we're really starting to see those Gini coefficients on the right side of the chart starting to get up to higher levels. And certainly if the expectation is, we see these downturns every sort of 7 to 12 years, then the reality is that these income inequalities will start to continue. There's an argument out there at the moment that's sort of saying, hey, look, it may make some sense that physical policy, which is the state and federal ministers spending money, is socially a better way to go. And so there's a lot of discussion around maybe these unconventional tools shouldn't be used unless it's really ultra necessary. But at the moment, they're sort of tossed out fairly easily. And I guess like any new form of medication, there's some refinement possibly that may need to occur as we progress.
Where do we sit with the markets and the upcoming US election?
Yeah, absolutely. 1950 going all the way back to there. September typically is probably one of on average, the worst months in the year of the calendar. I always say to clients, August through to the end of October usually is bad. The snow season historically is a terrible season for the share market. And so, this year looks to be no different. We're seeing a pullback at the moment. Right on cue. We like it. It sets us up for that seasonal rally into Christmas. So at this stage, pretty happy with it. We expect it to be pretty volatile between now and the US elections, and then probably the back end of November, things will smooth out and off she should go back upwards and continue along the path that we're sort of expecting. Pullbacks, normally we sort of see 8 to 12% pullbacks. That's normal this time of year, and at this stage it looks pretty much in queue. So nothing's really too troubling. For the US elections, we're not too phased really out of the two front runners what the outcome will be. Economically, it won't be devastating for the share markets or anything like. None of them have massive social agendas that are going to be really disruptive for the markets. Although it would be good for the social part of the economy, it would be. There's nothing in there that we can see that's going to tear the markets down in a massive way.
Okay, we'll come back here. What about the unemployment situation in Australia?
Yeah, we're sort of starting to see a couple of two-speed economies, and when we sort of look at the numbers that are on JobKeeper and JobSeeker, our expectation, so this is the current number of people in each state that are on JobSeeker at the moment, as the changes occur again with the JobKeeper program, we do expect these numbers to get higher. The Victorian numbers we expect to be in double digits. And certainly as that progresses. When we look at the next chart, we can see this is a rebound level. So when we're looking at things like New South Wales, we can see they've bounced back the number of jobs by about 70%. WA, SA, Tassie and ACT are fairly similar sort of recovery rates. We think, however, to get that, it's always that last third that's the hard part, and that's just that slow grind that's going to take a few years. There's tremendous pressure with Queensland around their unemployment situation, and it's, they've got the election, but certainly sort of post-election, that's really going to start to come up. You can see that the recovery's been really subdued and largely around tourism being shut off, which is a major engine room for that economy. So we might see some big policy shifts, but certainly into early next year, we sort of talked about that pendulum swift from, social aspects and moving towards sort of the economic outlooks. They're all going to be talking about job creation and how do we get these economies going from next year. And so, a lot of money has to be spent to try and get people back to work.
Each time I hear you speaking, I'm so glad that you're doing this, not me. It's fantastic. Thanks so much for your insights again today, Alex. I'd like to leave with a few notes that I've written down and basically saying to you to set yourselves up to win involves taking a prudent and sensible strategy. You do that for the medium to long term and making sure that you don't get distracted by the daily noise of the markets and commentators, and owning quality investments that will stand the test of time. Can I leave you with this thought and this slide? In the US, 88% of people earning over $100,000 own shares. This is in direct contrast to only 19% owning shares who earn $35,000 or less. The top 10% of the wealthiest people in the US own most of the stocks. So, of course, it's in their interests to protect their long-term wealth, thereby influencing business and politics. I think just understanding how the system is set up may give you some clarity in your own investing. So all the best in what you're doing. Thanks for joining us. Catch you next time.
The advice provided on this program is general advice only. It has been prepared without taking into account your objectives, financial situation, or needs. So before acting on this advice, you should consider the appropriateness of the advice and consult a finance professional. If any products are detailed on this program, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future performance.